Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Andy Baehr, Head of Product at CoinDesk Indices, Robert Leshner, CEO of Superstate, and Betsabe Botaitis, Chief Financial Officer of Hedera. They join me to discuss how token economics is creating new, real, viable economic opportunities. It is great to have everyone with us. Welcome to TradeTalks. And before we get into tokenization, clearly a hot topic in the industry. Andy, let's go around and tell us, what are you seeing within the space? Is consolidation continuing to occur?
I woke up this morning prepared to bring a consolidation, sell in May, go away story, and then we had this fantastic CPI number come out at 8:30 this morning, and everything takes off, tear up the script. Actually, Bitcoin's up 5% in the last 24 hours, really, on the CPI number. We like to think of Bitcoin as when it expects lower real interest rates, that's really the prompt. So this refuels some hopes that we get some more favorable central bank policy in the next 6 months. Interesting to see Bitcoin reacted more than Ether, which we of course expect as a macro asset. CoinDesk 20 is up 4% on some really strong performance by Near Protocol and by Solana. So it's a happy day. Our trend signal over the medium term is still pointing a little bit more cautionary since the Q1 kind of excitement that we had. So we'll see where things go from here.
Do you think there's been some exhaustion with the products that came out, or it's on to the next topic?
The flows have stabilized. The honeymoon over the ETF inflows has certainly run its course. The adoption's been great. The market structures work perfectly well. No complaints about how the ETFs are functioning. There's $52, $53 billion worth of them. We're still waiting for Ether ETFs. Meanwhile, offshore, our CoinDesk 20 index has traded almost $5 billion in the first quarter on bullish exchange and perp. So we know the market is ready for, we're at the Nasdaq site, so the QQQ of crypto is alive and well offshore, and we hope to bring it onshore sometime. We have the Consensus Festival coming up in just 2 weeks.
Which we will be a part of.
I'm so
They're
excited
live.
to see you there.
Yes.
So last year we had 15,000 people. We have 7,500 investors, a bunch of great speakers. And so it's going to be really exciting to go there this year and really see how much progress we've made since 12 months ago.
Yeah, it will be exciting to be there. And I think one of the key themes is going to be around tokenization. So let's get into that conversation right now. Robert, tell us a bit about Superstate. What's some of the work you have going on there?
So Superstate is an asset management business that's launching a variety of funds that we're providing the tokenization for on Ethereum and, in the future, additional blockchains. Mm-hmm. And our belief is that tokenized assets, when they're brought on chain, are superior to how assets are currently owned, recorded, and transferred today in legacy financial systems. And that we believe that there's more transparency, more efficiency, more programmability, and more autonomy to these assets. And our mission really is bringing products on chain. Our first fund launched a few months ago. It's a T-bill focused fund that provides crypto native investors, whether they're hedge funds or venture funds, the opportunity to hold treasuries alongside Bitcoin, Ether, digital assets, using the same custodians they currently use, using the same accounting software, trading systems, et cetera. And so we're bringing simple off-chain traditional assets on-chain for crypto-native investors.
Right, and that's key for institutional investors because they're used to those mechanisms, but then you're also required to separate some of these things out. Custodianship is really one of those key components to it.
It is, and digital assets are custodied very differently than
right.
traditional securities are, just because the way they're recorded, the way they're transferred, the way the records settle mm-hmm. is so fundamentally different. And we believe that the blockchain-based approach is superior. Transactions settle in a block. You don't have huge amounts of back office processes to record them. Things just work, but the way they work is different. And so, there's going to be a multi-year, multi-decade migrationary period as systems move from how they currently work today to being blockchain-based.
Yeah, and Betsabe, tell us about the economics of tokenization.
Yeah, I've been working in the industry since 2016, and I have seen how the definitions of token economics, tokenization has been changing. And I just want to set a little bit of the conversation that token economics, that is a baseline for tokenization, is real based on game theory. Where game theory, if incentivizes good behavior, it penalizes bad behaviors. And one of the things that we're seeing is that tokenization is really enabling new business models and is democratizing access in ways that we haven't seen it before. And in the same way, we are expecting to see new business models in ways that we haven't seen. These remind me a lot of the times of Uber and Airbnb, that we couldn't have them without GPS and without the internet. And at Hedera, we are very focused on the real world asset tokenization, and we are starting to see some very exciting products coming up.
Yeah, well, I think part of it too is, and this seems to, Andy, this seems to be the story around blockchain and integrating these technologies, is the efficiency and really creating that transparency.
Absolutely. We, as we're building new products, building multi-token indices, building systematic strategies, the problem that keeps coming up over and over and over again is when you're allocating to cash or taking risk off the table, how do you deal with that? Do you have to off-ramp back to fiat? Do you have to go out and buy treasury somewhere else? I like these very simple, very usable use cases where you can enhance collateral in a very transparent and blockchain-based way. You can keep your treasury allocation sitting there in the same custody account right next to your Bitcoin, Ether, CoinDesk 20 allocation. So it's maybe not super easy to access from a retail point of view kind of ideas, but these are critical pieces of market structure that can make a very big difference. Having an asset manager and the tokenizer be part of the same thing kind of carries through that fiduciary responsibility from end to end. So I think there's big promise for these things. Often people think of tokenization as a way to bring access to assets to places where those assets are hard to access in other ways. That's completely valid. I also just like this onshore kind of institutional way just to help accelerate things.
Yeah. Do they behave differently in terms of reaction to what's happening in the macro, or is it a little bit more stable than a traditional fiat product?
Yeah, the best way to describe it is you have a traditional asset that has its own market conditions. So like, T-bills. They're going to do whatever they would do to the assets held off-chain, right? In an environment where interest rates are going up in general, prices go down, but yields go up. They're going to have the exact same market responses. What's different is on the technology underpinning how the assets are recorded, how are they transferred, and what can you do with them after they're brought on chain. The economics are going to be identical. We're creating funds that have pretty much the equivalent returns and fees to any other, government bond fund. What's different is what you can do with the funds once they've been tokenized. And we're at an early phase now where just this week there was transferability enabled on our first product. So investors are able to transfer it for settlement or as collateral between different counterparties based on a blockchain on a peer-to-peer basis. And that's something that you can't do with most bond funds. And in the future, there's going to be more programmability. So different investors could start to add logic to how their assets serve as collateral or serve as settlement. They could set up systems where if they get margin called, it's instantly posted as opposed to using a back office and middle office. And so what you can do with the assets is different, but the economics of them are going to be identical.
Right, and there's other use cases as well, Betsabe, in terms of including AI and sustainability within the mix as well as it relates to blockchain. Tell us more about that.
Yes, absolutely. And as Robert was speaking, I was thinking exactly about the other use cases. For example, one of the use cases that we're seeing with a lot of strength is tokenizing carbon credits and tracing and tracking, especially in the manufacturing. One of the recent council members that joined Hedera, Hitachi, is working in tokenizing and tracing carbon emissions for many of their consumers and the clients. Another of the ones that I can see and is very exciting is in the real estate. A lot of the real estate funds are starting to tokenize so they can get access, democratize access to commercial real estate, but also for individuals to be able to afford and be able to put funds into lending pools to be able to get access to more assets. And also there are so many different ones, from diamonds, from tracking and tracing, from, as I mentioned, carbon trading and carbon tracing. The sustainability concept is very powerful and has seen real advances and benefits to humanity. From agriculture, or how do you trace the waste on food, and how do you deliver it and start tracking, but most Gen Z are very interested right now on the circular economy.
Yeah, it's so interesting. I'm thinking of climate risk management and reporting when you're talking about this, because you have layer 1, 2, and 3 of how you have your most immediate, obvious climate exposure, and then from suppliers and partners and so forth, and being able to track and detect that globally, it sounds as if that's another use case where it would make a perfect fit there.
Yes, and exactly one of the things that both Andy and Robert mentioned, there is a lot of legacy technology that we are a little bit, I would say baby steps. We are getting to it, we are building it, and I think that this is an important moment to connect AI with blockchain and DLT, because AI is going to help us to do those connections. As many governments as well as institutions are focused on AI and they are revamping the tech stack, this is the time when they are realizing how AI benefits blockchain and blockchain benefits AI. An example is data. Every single company, I will say, is in the data business. So how do you have responsible AI, and how do you trace the sources of data? That's a big concern on the AI. So right now, DLT, we had some use cases. Equity Labs is one of the companies that's building on Hedera, and they build a lineage for data to really trace where the data is coming and validate it. There are other use cases in media. How do you validate the images? How do you validate the data? And I think coming back to the original question, is really think that that's what is going to connect all these ecosystems together when AI and DLT are working together.
Yeah, I think it's an important conversation to have. I know, right, we're focused on digital assets primarily, but it kind of takes blockchain away from being, it's only about Bitcoin. It's only about trading. It's only about digital assets. I mean, as everyone is speaking here, I'm like, well, this is great for KYC and compliance functions as it relates to digital assets as an example, and kind of, removing that nefarious way of trading.
Totally agree. You look at the two different use cases. I'm really curious about how valuation works for an asset management product that's tokenized but really reflective of off-chain assets versus something like real estate or carbon credits, where you might expect the token itself to become the medium of valuation. I mean, how do you think about that?
Yeah, so at the end of the day, we're creating funds, and funds are a basket of different assets, each asset having its own value. With our product, at the end of every market day, there's daily financials that are put together by a partner of ours to create a net asset value on a daily basis so that investors can value the holdings. Eventually, there's going to be individual assets, the components of a fund, that get issued natively on a blockchain, either parallel to traditional record keeping or replacing traditional record keeping. And when that occurs, each of those assets will have to be valued, whether through blockchain-based financial markets or
an
indexer.
Right, there you go.
Yeah, but valuation, behaves similarly to how people think about valuation now. There's a market for each and every asset somewhere, and if it's an individual asset, you can see the price.
Right.
And if it's a composition of assets, you have to value the composition of the assets. What that enables is then people to combine that with the on-chain settlement and trading and record keeping really efficiently. But the way we value assets is still the old-fashioned way.
Oh, got it.
Would you think of tokenization as a derivative almost, or?
I think of it as infrastructure. In a lot of ways, it's not creating a derivative of a product or a new product entirely. It's just changing where and how do you record the ownership of it. It can either be in spreadsheets with teams of back office people making updates and like some computerization, or it can be done using tokens on a blockchain where the record keeping is updating in real time as transactions occur. And the modern approach is superior. It doesn't really change the integrity of the asset at all. What it changes is simply how much human time and labor has to go into tracking who owns this and how accurate is it. Blockchain-based systems are fundamentally superior for this. And it also opens up, floodgates of additional use cases that wouldn't be able to exist when an asset's ownership is tracked essentially in a spreadsheet. When it's tracked on-chain in a token that investors have custody and control over, and they can modify the ownership at their discretion, whether through using a computer program or using an interaction with the counterparty, or adding automation to it with AI or whatever.
Right.
That's where you get these really big upgrades to the financial system.
Right, and it almost sounds like the argument that everyone's making for AI by increasing that operational efficiency and not having to spend all that time on the spreadsheet. It almost seems as if it'll have to, the blockchain will have to be integrated with it.
And that's what we see. It has to be integrated. I mean, I can imagine when you have a lot of spreadsheets, you have, 50 people behind back office just creating everything, and the exposure to manual errors is very, very high. So now we are seeing with a lot of our council members and a lot of the projects that are building on Hedera that they are using blockchain together with AI as one unity. That's the new value proposition to reduce back-end office, but also to create value at the top, like these new business models that we haven't seen before. And that's what makes me very excited. And there are many of those coming up. I mean, being a blockchain native since early on, one of my dreams was to be able to use my own data and be able to monetize on my own data. When AI and blockchain together, this promise will be able to realize.
I also think that interoperability has significantly improved as well. I mean, that really was a key to adopting it, and I would say over the past 2, 3, 4 years, that was the key to it, was interoperability.
Yeah, I mean, that's the root of blockchains and crypto, and the purpose of them in the first place is, interoperability comes from having open, transparent, shared ledgers of ownership. Interoperability becomes trivially easy and better in that world versus every single bank or every single investor having their own record of ownership that might get into disagreements or errors or reconciliation problems with how other investors or owners see the world. And that integration and composability comes from blockchains and having like really one source of truth that everyone can see in real time as being accurate. It's just a better framework for assets to behave.
Yeah, and you think institutions are open to that?
Oh, they better be, because
I mean, you don't see an alternative.
As you're saying this, I'm thinking back to financial crisis 1, 2, and 3, and in there somewhere, there was always a failure of collateral management and as a key sort of vulnerability of risk management. And to the extent that that can be sped up and automated and put on a blockchain for everywhere to see, that you can't overstate how important that's going to be for the efficiency of financial markets, both on-chain and off-chain. So it's just a critically important development.
And I would like to expand that institutions, financial institutions, are truly testing. So there are many financial institutions that are running nodes in multiple layers. They know they need it. They're not perhaps completely open on it, but they are working on it. And they are testing it and running multiple nodes and multiple blockchains exactly to bring interoperability, because that will be key of success to our industry.
Yeah, I almost feel like it's the next iteration of how we see the capital markets going. As an example, look at what we learned from 9/11, right? We no longer have to shut down for crises such as that. We made it through the financial crisis and markets operated for the most part, efficiently. And then look at, how we managed the capital markets environment through COVID. I mean, we weren't on the desk for months, and it handled all that volume and the volatility and liquidity and so forth. It just feels as if this is the next iteration of modernizing the markets.
That's right. This will hopefully come through opportunity rather than through calamity.
Right.
And hopefully we'll all do this without a crisis having to force things to happen or to force improvement rather than just improvement happening organically or by opportunity. But I couldn't agree more. I liked your comment earlier about the derivative part, because although the collateral enhancement or the collateral efficiency part is important, I still think that price discovery of things like carbon credits or real estate can happen off-chain in a way that's more efficient than their traditional method. And you can have derivatives that actually help price discovery and help the kind of the front end of trading, as well as help the back end of making sure the trains are running on time.
All right, and we'll end that on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.